Welcome to this video presentation on the SYSCOHADA Accounting Framework. I'm your host, my name is John Paul Ngolo, and I will walk you through the basic as well as the more advanced concepts in the SYSCOHADA Accounting Framework. This means that this video presentation and those that will follow will be helpful for both individuals with basic knowledge in accounting as well as those with more experience or advanced knowledge in accounting. Don't hesitate to contact us. You have the contact information at the footnote of the slide, as well as you can write in the comment section on the internet page. So make yourself comfortable, whether you're at home, in the office, in school, or why not maybe in a taxi, and let the presentation begin. Here we have the 9 main classes of accounts in the SYSCOHADA Accounting Framework. This particular presentation will focus more on Class 2 fixed assets. We can subdivide Class 2 fixed assets into the different sub-accounts that you have on the screen. Account 2.1 intangible assets, 2.2 land, 2.3 buildings, 2.4 equipment, furniture and biological assets, 2.5 advances and payment on account for fixed assets, 2.6 investments, 2.7 other financial assets, 2.8 accumulated depreciation, and 2.9 impairment. We are going to have video presentation for each of these sub-accounts. However, you must note that these sub-accounts also have subdivisions. What is new based on the recent Uniform Act on Accounting Law and Financial Reporting are biological assets. This is to further align the SYSCOHADA Accounting Framework with the International Accounting Standards. So if you're okay with this review of the Class 2 fixed assets, let us go on to the table of contents of our presentation. The table of contents for the presentation that will follow, for this current presentation and those that will follow, I beg your pardon, will be based on an introduction on Class 2 fixed assets and an initial recognition criteria of Class 2 items. So the current presentation is based on the introduction on Class 2 fixed assets and the initial recognition criteria of Class 2 items. Subsequent presentation will deal with depreciation, impairment of fixed assets, and disposal of fixed assets. We are also going to have special cases or specific cases and the treatment of accounting treatment of those specific cases. These specific cases will be borrowing costs, revaluation of assets, research and development expenses, copyright, license, trademark, software and websites, investment property leases, and inspection costs. We are going to have separate video presentation for all of these special cases. So let us look at the initial recognition criteria, the definition of fixed assets, and the initial recognition criteria of fixed assets, the subject matter of our video presentation. So we have been talking about fixed assets for a while. But what are fixed assets? The assets which are expected to remain for a long time within an organization or an entity, usually for more than a year. These assets don't enter into the normal operating cycle of a business. It means an entity is not in business to maybe sell its fixed assets. It usually generates economic benefits by using the fixed assets instead of selling them. Fixed assets can be subdivided into three categories: intangible assets, what we cannot see or touch, they don't have any physical substance, like maybe copyright, patent, licenses. Tangible fixed assets, what we can see and touch, like buildings, equipment, plants, cars. And financial fixed assets, which represents cash or shares of another entity. An entity must make sure that it records all of its fixed assets. It must have a detailed inventory of the fixed assets. In some cases, it is called the fixed asset register. So even assets which are not used for the operations of the entity, but which belong or are controlled by the entity, should be present in the fixed asset register of the entity. Fully depreciated assets must also be present in the fixed asset register, but recorded at a value of 0, because obviously their net book value is 0. The fixed assets could be broken down into significant components so long as the following apply. The components of the assets are dissociable. It means we can have or we can separate the parts of the fixed assets. And those separate components or parts have different uses. The useful life or the duration of use of each of the components is different. It means part A could be used for 5 years, whereas part B could be used maybe for 8 years. And hence, the cost of each component can reliably be measured and is significant. It's a significant cost. If that's the case, the components will be considered as fixed assets separate from the fixed asset of the whole package, and each component will be depreciated based on its useful life. The current slide and those that will follow will look at the manner we use to acquire fixed assets. And hence, how do we initially recognize fixed assets in the financial statements? We may acquire fixed assets because we have purchased or the entity has purchased fixed assets, or they may be acquired as gifts or donations. Fixed assets also can be acquired because the entity has constructed or built the fixed asset itself. Another means are fixed assets acquired through an exchange of assets. It means giving an old asset to acquire a new one. You exchange an old asset, you give out an old asset, and you acquire a new one. Fixed assets can also be acquired through shareholders' contribution, which means shareholders decide not to contribute, or owner of the business decides not to contribute cash into the business, but to contribute fixed assets. Maybe give a land to the business or to the entity. Fixed assets can also be acquired through leasing and payment of fixed rentals or payment of life annuities. You can also have spare parts or standby equipment which could be considered as fixed assets when they are principal spare parts and standby equipment. And the last method is through major inspection costs, which, due to the value of the inspection cost, due to the high value of that inspection cost, is also considered as a fixed asset. So in the slides that will follow, we are going to look at each of these different initial recognition criteria and the double entry that we are going to use to record the fixed assets in the financial statements. It's true that as a whole, when we initially recognize fixed assets, we are going to debit the relevant fixed asset account. So let us start with purchase fixed assets. Our aim is to be able to determine the initial value of the purchase fixed assets in the financial statements. And so we are going to add the following elements. First, the purchase price, less discounts and recoverable taxes. Next, extra costs like transport expenses, custom duties, and the rest, still less recoverable taxes. Thirdly, incidental expenses to purchase, less recoverable taxes, like commissions you have to pay, professional fees, registration duties. In other words, you understand that this cost means the cost incurred to bring the asset into its present location and working condition. And if you notice, recoverable taxes are not part of the cost of the asset. Hence, in the double entries, which we are going to see in the next slide, recoverable taxes like VAT are not part of the cost valuation of the fixed asset. However, the SYSCOHADA standard does not end there. We also have an estimation of future costs which will be incurred due to restoration or removal or maybe dismantlement when it is an obligation for the entity. This usually happens in cases maybe in the mining sector where an entity has signed a contract to carry out mining maybe for 20 years or 30 years, and at the end of that period of time they have to restore the environment as they met it. In that case, that future cost, which will be incurred in maybe 30 years time, has to be estimated and included in the cost valuation of the asset today or at present date. So even though it's a future cost, it is a cost that the entity will incur, and so it will be part of the total cost incurred on that particular contract, and hence is part of the cost of the asset. Also, we have borrowing costs. This could be the interest paid on a loan acquired to purchase or to construct a fixed asset. That interest payment will be capitalized into the cost of the asset and depreciated alongside the asset based on the useful life of the asset. We are going to have special video presentations on this dismantlement and restoration costs as well as borrowing costs to see how we can account for them based on the SYSCOHADA accounting framework. So let us look at the double entry. First, when the asset is paid with cash, check, or equivalent, it means you're going to credit the relevant treasury account. It means maybe credit 52 if you are talking about payment through check, or maybe 571 if you are talking about payment through cash. We will debit the relevant fixed asset account. If it's an intangible asset, we are going to debit account 21. If it's land, 22. If it's equipment, account 24. But if the asset is purchased on credit, in this case, we will debit the relevant fixed asset account, I beg your pardon, and we will credit account 481 investment suppliers. Account 481 is used to distinguish between suppliers of fixed assets and suppliers of goods or operational assets. Suppliers which are there for operational activities are accounted for in account 401, whereas suppliers which are there for non-operating activities like fixed assets are recorded in account 481. The second case is fixed assets acquired as gifts, and these assets are measured at their market value at the date of the transfer of the fixed assets. Remember that as it's a gift, there is no cash or transfer of cash or promise to transfer cash. So they are recorded at their market value at the date of the transfer. To be able to record fixed assets acquired as gifts in the financial statements, we are going to debit the relevant fixed asset account and credit the relevant account 14 investment grants and subsidies. This slide deals with self-constructed assets, which are assets which are built by the organization. And these assets are recorded at their cost of production. The cost of production includes the raw materials and consumables used at their purchase price, direct production costs like maybe the direct labor used, maybe the direct overheads used in the production of the fixed assets. Also, indirect production costs could be included into the cost of the assets so far as they can reasonably be attributed to the production of the asset. And this part is very important. It therefore means that allocated costs or shared cost cannot be part of the fixed or the valuation of the fixed asset. Then we have the future dismantlement cost, which we saw under purchase fixed assets, as well as borrowing costs. Borrowing costs are more used under self-constructed asset because an entity may usually have to take a loan in order to build a building, for example. The double entry of self-constructed assets. You debit a fixed asset account. Obviously, when you initially recognize a fixed asset, you must always debit the fixed asset account. But in the case of self-constructed assets, we are going to credit account 72 manufactured goods capitalized when the entity removes an item of stock and uses it as a fixed asset. For example, take a case of a company which produces computers. Computers are part of its stock. But if it decides to remove one of the computers from stock and use in an office, in that case, they are going to credit account 72, which accounts for the removal of the asset from stock, and debit the fixed asset account. But if it's a case of a fixed asset which was built and which was in progress, the work in progress will have been recorded either in account 219, 239, or 249, which deals with, as you see the names or the labelings, in progress. So when the fixed asset has been completed, these accounts should be closed, and that's why they will be credited, and we debit the relevant fixed asset account. As I mentioned earlier, because we are initially recognizing fixed assets and assets are debit accounts, that's why we always debit fixed asset accounts when we are initially recognizing the fixed asset. Fixed assets can also be acquired through an exchange of assets. This simply means an old asset is exchanged to get a new asset. And in this case, the new asset which is acquired will be valued at fair value or market value. And the asset which is disposed of will be valued at its net book value. In other words, that will be the cost of disposal of the net book value asset. This simply involves a case of disposal of a fixed asset where the consideration of the disposal of the old asset is not cash, but it's another asset. So on the video presentation that will look at disposal of fixed assets, you are going to see the double entry which relates to the disposal of fixed assets. But in other words, we'll debit account, the relevant fixed asset account, and credit account A2, which looks at the income on the disposal of fixed assets. As mentioned in the previous slide, this is the double entry used to recognize the fixed assets that were acquired through an exchange of assets. We debit the relevant fixed asset account and we credit account A2, income from the sale of fixed assets. The part of the disposal of the fixed asset will be seen when we are going to treat disposal of fixed assets. The next type we are going to look at are assets acquired through the contribution of owners or shareholders of the business. And when these owners or shareholders contribute in kind, these are accounted for at the value found in the Contribution Act of the business or the Memorandum of Association. In that case, what we are going to do still, we debit the relevant fixed asset account and we credit account 10 capital or account 46 partners and groups. Account 10 capital, especially account 102, will be used when we are talking about the capital. 103, I beg your pardon, will be used when you are looking at the capital of a sole proprietor. And account 46 will be used when we are looking at shareholders contributing fixed assets as part of their shares. In other words, they contribute fixed assets to acquire shares in the business. The following slide looks at the accounting of fixed asset acquired through leasing or payment of life annuities. And these assets are valued at the amount stipulated in the contract between the two parties or at the fair value at the date of the contract. The fair value at the date of the contract will be the market value at the date of the contract. In that case, for leases, we are going to debit the relevant fixed asset account and credit account 17, lease liability account. We are going to see how subsequently we are going to treat lease liabilities, the subsequent accounting on for leases, and hence how do we de-recognize leased assets. So we debit, the initial recognition is for us to debit the relevant fixed asset account and credit the lease liability account. If you notice in our examples of the two fixed asset accounts for lease liabilities, both of them end it with 6. Fixed assets acquired through leases are recorded in special sub-accounts based on the Ohada chart of accounts. Assets with, account numbers with 4 digits and ending with 6 are used to record assets acquired through leases. So fixed asset accounts with 4 digits ending with 6 are used to record fixed asset acquired through leases. So let it be 2416, 2426, or any other fixed asset account ending with 6. Note that any other fixed asset account with 4 digits, ending with 6, know that it deals with lease assets. So in the case of life annuities, we still debit the relevant fixed asset account, but in this case, we are going to credit account 1681, capitalized life annuities. We are also going to see on special cases in a separate video presentation how do we subsequently account for these capitalized lease annuities, and hence maybe what happens at the death of the party. Principal spare parts, standby equipment, and servicing equipment can also be considered fixed assets. This will be the case if the entity will use them for more than a year. If that's not the case, then they will be accounted for as stock under Class 3. Standby equipment will begin to be depreciated when the principal fixed asset has been acquired. The principal fixed asset to which the standby equipment relates, when that principal fixed asset is acquired, that is when the standby equipment will also begin to be depreciated. However, for spare parts, depreciation begins at the date when the spare part is used, and only at the date when the spare part is used. And the last type of fixed assets which we may initially recognize is major inspection, or maybe a major overhaul cost. And this is a cost carried out and which should not be recognized as an expense but as a cost. It means during the year we are going to recognize the cost as an expense, but at the end of the year that expense account will be credited and will debit the relevant fixed asset account for this major inspection. The inspection costs are depreciated during the period separating 2 inspections. This is important to know that will determine the useful life of the inspection cost, the period separating 2 inspections. So we are at the end of our presentation. I hope you have enjoyed the presentation. I hope you have learned something with this presentation. If you have any questions, any comments, any suggestions, hit the comment section on the page, or else contact us on the email and phone numbers that were made available. We hope to see you soon for other video presentations on the SYSCOHADA accounting framework. Thank you.